Being self-employed is so much easier and less stressful than working for someone else, said no one ever. That being said, there are obviously many positives to being self-employed, otherwise you wouldn't be doing it. But one of the things that's definitely not easier to navigate when you're self-employed is health insurance. And that's one of the main things that may hold people back from making the leap to self-employment. It's estimated that people who are self-employed are 25% less likely to have insurance. Unfortunately, they're not 25% less likely to need insurance. Additionally, those without health insurance are far more likely to put off getting the preventative and basic care that they may need. Unfortunately, this means that those issues that start out little can suddenly snowball and become big, scary, and expensive issues that land you in the ER. In the US, emergency room charges average somewhere around $2,200. However, 25% are well over $3,000, and if you need surgery, it could be well over $20,000. So obviously, as health insurance brokers, we often see people in the worst, most stressful situations when they finally reach out to explore health insurance options. So it's definitely our opinion that you shouldn't go without. But if you're self-employed, it can certainly be cost prohibitive. So let's talk about some health insurance options when you're self-employed and give you some tips to save money on medical expenses. So one of the most obvious choices is, of course, a marketplace plan. Now, all marketplace plans must offer at least the 10 essential benefits. And this is really a great way to save money on medical expenses because treating conditions when they are in the early stages and taking preventative care is far less expensive than that which might come later. Now, another way to save money on your marketplace plan, and I can't emphasize this enough, is to understand what your needs are and how that best aligns with the different types of plans. Do you have a good relationship with your PCP? Is it very easy to contact the office and get a referral if you need to see a specialist? Are you willing to sacrifice a little bit of that flexibility in favor of a lower monthly premium? Then perhaps an HMO is the way to go. If you need a little more flexibility and are perhaps willing to pay a little bit more on your monthly premium, then you might want to go with an EPO. Know which plans your doctors and hospitals accept so you don't wind up with big out-of-network bills. Have a list of medications you take so you can compare costs on the different plans. Are you pretty healthy and do you really only need that basic preventative care and something in place should the worst happen? Then perhaps you might want to go with a lower premium, higher deductible plan, or something that has a higher cost sharing on your part like a bronze or a silver plan. On the flip side, if you're already undergoing medical treatment or you need to see specialists more regularly, or even if you have a procedure already planned, then you might want to go with a plan with a higher monthly premium, but a lower deductible, and a lower cost-sharing responsibility on your side, something like a gold or a platinum plan. These are all questions that your broker will go through with you, these and many more, to help you determine what is the best plan for your needs. And if you do need help, you can reach us at iHealthBrokers at the number on the screen or in the comments below. We are licensed nationwide with absolutely no charge for our services. And a shameless plug, please make sure to like and subscribe to stay up to date. All right, back to it. Now, one of the best ways to save money on a marketplace plan is, of course, with those premium tax credits. And this is where speaking with an accountant comes in. As someone who's self-employed, you have many more opportunities to maximize on different deductions that you can take. And that's why it's important to work with an accountant up front. Because the lower your income, specifically your MAGI or modified adjusted gross income, then the higher your premium tax credit. And premium tax credits are really just a tax credit that is paid upfront and is reflected in a highly discounted monthly premium. On healthcare.gov, if you put in your zip code, it'll either take you to healthcare.gov or redirect you to your state's individual marketplace, and then it'll ask you a few simple questions to determine if you're eligible for a premium tax credit and estimate what that might be. So I highly recommend that you do click where it says start, tell you about, who's in your household. Let's put us and other people. Continue. We'll put married. I'm going to go through these as quickly as possible. Yes, we'll claim dependents. Let's say 2. Continue. Tell us about you. 35-year-old male who is a legal parent. Continue. And let's say our spouse is a 35-year-old female who is also a parent. Continue. And then let's say we've got 2 twin boys. Quite a lovely family. Okay, so this is our household. Confirm. Now we're going to estimate our income. So I want to show you this a couple different times so you see how that affects your premium tax credit. So let's say our total income is going to be $80,000. Your estimated premium tax credit is $1,104 per month. This is an estimate. Then if you were to view the plans, let's just skip this, what you will see is that premium tax credit applied and what your estimated monthly premium would be. I'm going to go back and I'm going to adjust the income that I put in. Let's put 70,000. I want to put 70,000 this time. This is why I wanted to look at this. You may be eligible for extra savings if you pick a silver plan. If this pops up for you, that you may be eligible for extra savings with the silver plan, please, please, please look at the silver plans very closely, because with these extra cost savings on deductibles, copays, and coinsurance, it very often works out that a silver plan is actually going to be a better deal for you than even a platinum plan when you actually utilize your health insurance. So take a look at that, and then we can actually sort by silver, apply filters. And you'll see you'll still have some pretty reasonably priced for a family plan, silver plans that will offer you tremendous cost savings with those extra cost savings offered by silver plans. Now, of course, if you wanted to skip these questions or you made significantly more money, then you would see full priced plans, which are going to be a lot more than what we were looking at before. Another benefit that may be available to you through the marketplace are HSAs, which are offered sometimes in conjunction with HDHPs. I know it's a lot of acronyms, but an HSA is a health savings account. It's just an account that's offered sometimes as a benefit in conjunction with an HDHP, or high deductible health plan. Now, HSAs aren't necessarily ways to save money, but they can be ways to make money. As I said, it's a separate account and it can be used as a wealth building tool, and that's because it offers that triple tax advantage. An HSA is a separate account with your money in it, and you can contribute up to the threshold set by the IRS every year. Now, the amount that you can contribute is actually pre-tax, therefore lowering your taxable income, which can save you money when it comes time to file. Also, HSAs are interest-bearing, and the interest accrued is not taxable. As long as you withdraw funds for a qualified medical expense, and surely the list is extremely long, then there's no penalty or taxation, and you can even use your HSA as a wealth building tool, as I mentioned. That's because you can actually invest a certain portion of your HSA, and any earnings on those investments are not taxed. Now, you can withdraw funds from your HSA for qualified medical expenses, or you can hold on to it because that money will roll over year. And if you do hold on to it until you're 65, then you can convert it to a basic retirement account. Again, it's not necessarily a money saving tip, although I guess it could be, because you could maybe have to pay a little bit or maybe get a bigger refund come tax time by lowering your taxable income, but it's more so a wealth building tool. HSAs are only available with HDHPs, high deductible health plans. However, not all HDHPs offer HSAs, so if you are interested in an HSA, it's very important that you filter for that benefit when comparing plans on the marketplace. Another good thing about HDHPs is that plans with higher deductibles tend to have lower monthly premiums. So if you are an individual who is maybe in good health, looking to just take advantage of the more basic and preventative care, but still have an out-of-pocket maximum in place to protect you, then a high deductible plan might be ideal anyway. Now, in the past, we probably would have spent a good chunk of time talking about short-term medical plans. However, they're not necessarily as much of a viable option as they once were, because as of September 2024, they're only going to be available for a period of up to 3 to 4 months. That being said, they can still be a very good option if you need nationwide PPO coverage and if you are ineligible for a premium tax credit, especially if you are just looking for some type of stopgap solution to insurance. Short-term medical plans were sometimes referred to as catastrophic coverage plans, and honestly, that's not really accurate. There are many differences between the two. However, you may want to look into an actual catastrophic coverage plan. So catastrophic coverage plans are really just there to protect you from the worst. They'll offer low monthly premiums, but they will have higher deductibles and higher out-of-pocket maximums. They're really just for someone who wants some type of bare bones protection in place should the worst happen, while still being able to see their doctor for basic wellness visits. You can also get more cohesive coverage by supplementing a catastrophic coverage plan. More on that in just a moment. Now, catastrophic coverage plans are available on and off the marketplace, and there are pros and cons of each.
Now, for plans on the marketplace, they're really just available to people who are under 30, except for those who qualify for a hardship exemption. Now, if you are eligible for a premium tax credit, then this is probably not the way to go because the catastrophic health plans on the marketplace, those premium tax credits do not apply. However, they are going to be significantly less expensive if you're comparing them to a plan without a premium tax credit. A major benefit of catastrophic health plans through the marketplace is that they will always offer those 10 essential health benefits, and you will have at least 3 primary care visits per year before you've met your deductible. Now, for plans offered off the marketplace, private catastrophic coverage plans, they're not beholden to the same rules as the Affordable Care Act, so these benefits are not guaranteed. That being said, you will have more flexibility with a private catastrophic coverage plan. You're more likely to get a PPO plan, nationwide PPO coverage. And of course, there's that medical underwriting, which is a pro and a con, because if you're somebody who is very healthy, then you might have a better rate than a marketplace catastrophic coverage health plan.
Now, as I mentioned, catastrophic coverage plans can be combined with other things to form more cohesive coverage. So what I want to talk about now is DPC, which is direct primary care. Now, this isn't actually insurance, so if you are interested, it's not really something that we can assist you with, but I just want you to be aware that this might be an option for you. DPC is like the medical version of a dental savings plan, and if you do need dental insurance, I'll put a link to those videos at the end of this. So DPC, direct primary care, is an agreement between you and your doctor which will give you greater and more direct access to your doctor and the basic services that they provide. Now, this is great because it can help to make sure that your basic care is taken care of. However, you will have issues if you need to see a specialist or go to a hospital, and that's why people supplement DPC with some type of catastrophic coverage plan. Then there are what I like to call lump sum payout plans. Basically, I want to talk about critical illness plans and hospital indemnity plans. They are similar in the way that they work, although different in how and why they pay out. But they are a supplemental form of insurance that you may want to look into. Now, there can be disqualifying factors with both of these types of insurances. If you are already ill or if you're expecting a hospitalization, then that would likely disqualify you. If that's not the case, for a hospital indemnity plan, you would pay a monthly premium, and then if you do need to be hospitalized, based on the terms of your plan, you would receive a lump sum payout. Similarly, with a critical illness plan, you would pay a monthly premium, and then if you were diagnosed with a critical illness based on the terms of your plan, you would receive a lump sum payout. The good things about these types of plans is that that lump sum payout can be used for whatever. It could be used to pay your medical bills. It could also be used to pay your mortgage payment. It's really up to you how you use it. Now, I want to warn you about health sharing ministries. I'm not just warning you because they are not insurance. We've talked about DPC in this video. We talk about dental savings plans in other videos, and those are not forms of insurance either. However, they don't share the same dangers that health sharing ministries do. In these types of agreements, you agree to pool your funds with other individuals in the hopes that should you need medical care, you will be reimbursed based on the terms of your plan. However, there are so many downsides. The terms of this plan are very, very loose, and the regulation is pretty much non-existent. Many people report extreme difficulties in being reimbursed, and the very fact that you have to be reimbursed means that you have to pay up front, which can be a severe financial hardship. They are also famous for their morality clauses. There was a case where a woman was denied reimbursement because she broke her leg outside of a bar, and that was deemed in violation of the morality clause. She was literally outside of the bar. There have been countless cases of children with cancer being denied reimbursement, and I don't really see how this is moral. But anyway, additionally, there are no rules dictating how the funds are to be allocated, so most of the money that you pay could actually go towards marketing and administrative fees rather than the actual reimbursements. So please stay far, far away. Another thing I just want to throw out there is it is always best to stay informed. Obviously, you're doing the right thing by watching this video, but please be aware, and I feel like I say this in almost every video, but it's so important. It's estimated that up to 80% of medical bills have some type of error in them. So always double check before you just go blindly paying them. Call the doctor, call your insurance carrier, call your broker, call the hospital. Get it rectified before you just go ahead and pay it. And also remember that many hospitals are willing to work out structured payment plans or even discounts if you're unable to pay your full bill. And there are other types of insurance that you may need as well. For example, vision and dental. And if you do want to learn about dental insurance or even those dental savings plans that I mentioned, make sure to check out this video here. We also have a playlist dedicated to those who are self-employed. As always, if you have questions, you can reach us at the number on the screen or the comments below. Please make sure to like and subscribe, and we'll see you next time.